Do you guys know that you also lend your money to governments and corporation? If not, then it is called bond. Hey guys, welcome to Money Mindset and more. And today I'm quickly going to cover what is a bond, what types of bonds are available in the market, and why you should be watching it closely because many of the other asset classes depends upon how the bond market is performing. So first, the bond is something which is a loan which you offer to a government or a corporation who is issuing those bonds against certain payments. Those payments are normally called coupon in financial terms, but simply put, it is a interest earned on your money given to the government. So for example, if US Treasury bond is giving you 4% return, so if you buy $100 bond, you will get $4 as a return on investment for your investment. On the other hand, for US government, that 4% is actually their interest payment on the loan which they have raised through the bond. So that's why if you have seen US balance sheet, they have probably almost $1 trillion interest payment in their balance sheet. For US government, that is a huge expense because they are paying those interest on the bonds. But people who have bought those bonds, they are actually making that much money from the US Treasury. So for US government, that's an expense. For people who have lent money to US, they are making money out of it. Now, normally in every bond, there is a maturity period, and after that maturity period, the the person who has taken or the government who has taken the money has to return the money. Now, in case of US government, what they are doing over years, they are issuing new treasury bonds once the maturity period is completed. And that's how they are, if you see their debt is rising every single year, the reason is the very same that rather than paying that principal amount, they are keep issuing new treasury bonds against the old loan, and that's how they are keep piling trillions of dollars in their balance sheet as a loan. So their debt ceiling is really, really going high. Now, that is a separate part I cover some other times. When coming back to bonds, there are 6, 7 types which you can be very careful and aware about. There can be multiple, but the first one is government bond, which I covered. Most of the government issue a lot of bonds to raise money from the public. Normally, they are linked to the infrastructure projects because they are multi-year. They need a lot of money. Most of the government try to involve the communities and their citizens and other institutions to raise money, and that's how they normally issue infrastructure bond, which is very common. Second, corporations also can issue bonds to raise money rather than going for a traditional loan with a bank. They can go to the public and say, we are giving you a bond. Against those bonds, we will give you, let's say, 5% return over 10 years, and you have to give us, let's say, $1 million. Those are the corporate bonds. Then there are inflation covered bonds. Sometimes there is a specific name for that, but those bonds normally cover whatever loss you are incurring because of inflation. Normally they are higher than the market rates because they are trying to cover the inflation part of it. Then there are bonds which are fluctuated with the market price. So if the market rates is going down, the bonds will go down. If it goes up, bond goes up. A classic example is Silicon Valley Bank. When during COVID the interest rate were down, they had accumulated a lot of government bonds. Once the interest rates are rising, they have to pay those interest rates, and that's how once they declare that they have to pay this much interest on the bonds, they collapse and ultimately got bankrupt. So you have to be very careful with the market fluctuated bonds. Then there are bonds which are linked to green projects. There are bonds which are perpetual, no maturity, and there are bonds which with no coupon or no return on investment attached to those. So you have to be very careful which kind of bonds you are buying. Many a times I have seen people buy bonds which does not have any coupon attached to it, and then they say bond is not a good investment. So you have to be very careful before investing. There is one more very common bonds which people have bought over the years is convertible bonds, and you must have seen that in the market as well. Those are the bonds which can be converted into equity. So it works like this: let's say you have given a loan, or you bought a bond from some bank, and you have the option to convert into equity. So if you have given $100, you might be earning 4% interest rate on a convertible bond. But if that bond converts into equity, you might get $100 worth of equity in a company, but you are not going to get that 4% interest which you were getting on the bond. So you have to be very careful about when you are trying to convert any bond into equity. You have to be certain, because once it is converted into equity, it cannot go back to become a bond. So it might be, but most of the time it is not. So equity is something which is your own stake in a company. You will be partial owner. Bond, in the case of bond, you are not owning any piece of the company or a state or a country or anything. You are simply having a bond against which you will get the your interest rate and your rate of return or interest rate, whatever that is. Now, the more bond market you have to follow very carefully. What I feel that everything is linked with them from the other market and other asset classes as well. So, for example, whether it is equity or it might be gold, or it might be other commodities, based upon how the bond market is performing, all those asset classes will be impacted as well. So for example, in case of you have more supply of bonds in the market than demand, in that case, normally what central banks do across the globe, they try to create demand by printing money, and that way they can create the demand for the bond. But at the same time, because they are printing more money, the inflation will go up. So if you have seen the trend across the board in last 1 to 2 years, the inflation is going high in many of the countries, including US, which is a very developed country, and inflation is something which is considered uh, very high when it comes to the capital which they have available for investment and other things. Normally US has low interest rate for years and years, and they are actually reducing, but still they have high interest rate because they want to keep those demand supply balance in the market, and based upon that they are not lowering the rate, and ultimately the economy is getting a little bit suffering. And but the valuation of the dollar and everything is intact, right? But as an individual investor, you are not going to control those things which are policymakers are doing. So you have to, only thing which you can do, you have to make sure that you are paying close attention to the bond market. If it is, there is a lot of supply gap, a lot of demand gap, based upon those you can buy, or you can allocate your investment into gold, commodity, equity, whatever way you prefer, real estate, but link everything to that. Why I say that all the time? Because bond is the safest, probably most safest, I would say, in all, including all other asset classes, because they are always backed by either a big corporation with assets, or by a government like US government, which is stable. People know that it's a strong country, developed country, so backed by US government. So if anything's backed by any government, even in countries like India, where governments are not that powerful globally, but still local people, citizen always prefer their government backed securities over corporate backed security or a foreign institution based security. So if anybody is losing faith in their own bonds, it means that they are losing faith in their own country or their own government and institutions, and that's a very bad sign. So the moment you see those things, you have to make sure that you divert either from that particular market or that particular asset class and things like that. So my recommendation, always you should have bond in your portfolio. At the same time, you should be following the market very carefully to see whether it is trending. Happy to discuss anything more on this, and happy to learn from you guys. Please like, share, and subscribe. Thank you very much. See you next time. Bye bye.